Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. Today we begin a new series on trending topics from one of our most popular guides, the Foreign Currency Guide. In today's episode, we dive into the determination of functional currency. This determination is made at each distinct and separable operation of the reporting entity, and depending on the economic environment of those operations, can get very complicated very quickly.
Business and companies in general are just increasingly global. These foreign currency topics probably affect the vast majority of our clients in some way. Think of it whether it's through foreign currency sales or, like we're talking about today, foreign operations.
That was Brett Dooley, Deputy Chief Accountant in PwC's National Office, who leads our financial instruments team. Brett's joined by John Horan, a Managing Director, also in the National Office. Brett and John address these and other matters with our clients every day and share that knowledge and their insights on the podcast. And if you stay tuned all the way until the end of the episode, you'll even hear me crack a very bad dad joke. Let's listen to the episode now. So Brett, John, so nice to have you guys back on the podcast. And as our listeners know, this is one of our podcasts in the series covering our most popular guides. And for our next two episodes, we're going to be covering foreign currency, which is a great topic. And I think, John, one, you've probably been on the podcast to discuss at least 5 times, maybe more than that.
Quite a few over the years.
Yes, quite a few over the years. But it's still always good to have a refresher and to kind of look at things from a new angle. So maybe with that backdrop, Brett, going to you first, why functional currency as one of our two topics?
Yeah, sure, Heather. I think the short answer to that question is that business and companies in general are just increasingly global. These foreign currency topics probably affect the vast majority of our clients in some way. Think of it whether it's through foreign currency sales or, like we're talking about today, foreign operations. And we're going to do a couple podcasts of these. And it's a complicated topic because it's sort of intertwined. And I think it's to understand why we're talking about functional currency, you have to have an understanding of the consolidation process at a high level. So each reporting period, companies obviously consolidate all their operations, both domestic and foreign, into a single set of financial statements with the objective of giving an overall snapshot of their financial health. So that process of consolidation starts with each legal entity remeasuring all of its monetary assets and liabilities that are denominated in other than its functional currency into its functional currency. So you have to start this consolidation process with the starting point at a foreign operation level. And then with changes in functional currency amounts are going to be reported through earnings. And that entity's functional currency financial statements are then translated into the reporting currency of the ultimate parent. So all of the operations are then shown in the context of a single currency. And so that's why this determination of functional currency is so important, because it has an immediate and direct impact on the consolidated financial statements through that remeasurement through earnings. But like I said, all of this is intertwined. And so we'll have another podcast talking about that whole remeasurement process. I encourage listeners to listen to this one, listen to that next one, and then come back to this because you'll understand this functional currency process once you understand this whole, the bigger picture of the whole remeasurement process too.
All right. So, Brett, that's helpful and good background. And so then just at a high level, at least, how do you go about figuring out what is the functional currency?
Yeah, so I think there's several steps to go through in doing that. And the first is to identify what your foreign entities are. And so this is, one of the things we often deal with clients and engagement teams. I think, well, this is easy. I'm talking about foreign entity. So I look for my legal entities that are located in a foreign location. But that's not what foreign entity means. And it's actually a defined term in ASC 830. And in that definition, it starts out talking about a foreign entity as an operation. For example, a subsidiary, division, branch, joint venture, and so forth. And so when you think of anchoring this to the definition of, and starts with an operation, it may be a subsidiary, but it may not be. And we think that a foreign entity doesn't necessarily need to meet the definition of a business like we use in general accounting, but it needs to be somewhat close. And so we think of a consolidated operation must be distinct and separable from the reporting entity's other foreign operations in order to be considered a separate foreign entity. So this concept of distinct and separable operations, think of it as operations that can be managed independently and can be separated both operationally and for financial reporting purposes from other operations. So you need to start with thinking about what are your distinct and separable operations. And a reporting entity should start by analyzing the business purpose and activities of each legal entity. So I do suggest that the legal entity is a starting point, but it's not going to be an ending point. So, and begin with the lowest level of the legal structure. Determine whether each legal entity is a distinct and separable operation. And this process, can often involve significant judgment.
And then, Brett, maybe before we dig more into that, just one question on the definition of a foreign entity. And to be clear for our listeners, even though you can't hear this, foreign entity is capital. So that's a defined term in GAAP, as Brett did say. But so, Brett, when we're talking about either the subsidiary, division, branch, et cetera, are there any other criteria we need to think about with that before we kind of jump into identifying if we have the foreign entities?
There are. The financial statements for that foreign entity need to have two characteristics. One, they're prepared in a currency other than the reporting currency of the reporting entity. So you're going to have preparation in a foreign currency or different than the parent. And then they're combined or consolidated with, or they could be on the equity method in the financial statements of the reporting entity. So I think the critical thing is probably that first one, because we're always dealing with these consolidated statements, but you've got to think about that you have financial statements that are prepared in a foreign currency.
All right. So then,
Heather, there's just one thing in terms of, you got to remember when you're dealing with ASC 830, it started with FAS 52, which was written in 1981. And so it's very old. It comes at the issue of foreign currency from the perspective of a corporate structure in 1981, which can be very different than it is today. So typically that structure was a U.S. parent with foreign operations. It's possible today to have, U.S. parent, foreign operation, U.S. operation, foreign operation underneath that. And so it's possible that even though it's not in a currency other than the reporting currency, assuming the reporting currency is the U.S. dollar, you still have to think about your separate and distinct operations. One of the reasons we use that term rather than foreign entity, that may be U.S. dollar functional, that report to entities that are foreign entities that have a functional currency other than the U.S. dollar.
And then that entity is, if that entity is reporting in other than. Okay. And so, John, to be clear then, two questions follow up. The first one, I think is straightforward. So we talked about this U.S. parent and then foreign, et cetera. If I'm a U.S. GAAP reporter that is headquartered in, for example, the U.K., then it would be UK parent from that point of view. So we're going to use US throughout. And so the US is the ultimate parent, but it depends where you're headquartered.
Absolutely. We have clients, US GAAP reporters that have other than, US dollar reporting currencies.
Okay. So I think that's a key point. And then I guess the other point then going back to where Brett was going is you're saying, okay, yes, you have to make sure you meet this criteria about the financial statements, but that doesn't change the fact that you need to identify these distinct and separable operations. And that's really the starting point. And then it's almost like this is almost like a check to make sure once you've identified these. Is that fair?
That's right.
All right. John was nodding at me, but I needed that confirmation. So, all right. So then, Brett, let's go back. So what are some of the examples as you start thinking about identifying these distinct and separable operations?
Yeah. Maybe start by giving a few examples where you do this legal entity-based analysis and you find some that won't be considered to be foreign entities. I'll give you three examples. One is a sales office. So what's a sales office? A sales office can be primarily responsible for identifying potential customers and servicing those customers by educating them about products, ensuring delivery, responding to complaints. But it really just consists of a few salespersons, computers, and administrative staff. There's no real operations going on there. Another example, maybe the flip of that, is just a manufacturing facility. We often find that these are not considered to be foreign entities. A parent may send a host of materials, a kit or raw materials to a facility in a foreign country. And that facility is responsible for assembling or producing the product and just shipping it back to the parent or directly to customers. But there's no sales, marketing, research, strategy, or other function, and it's just funded on a cost-plus basis.
And I guess, Brett, this is where you go to that can be this idea that doesn't have to be a business, but you have to have some of the characteristics. I guess this is where the judgment comes in, right?
I think that's right. It's probably clear in a situation where literally this foreign entity or this foreign operation, I should say, I'm going to catch myself,
yes.
Right? This facility is just manufacturing. It receives a kit of materials and just assembles it and then sends it right back. They're not doing anything. They don't have any strategy. They don't have any customer facing. When you have a couple more of those characteristics, it may blur the lines a little bit, and that's where I think the judgment's going to come in.
For the poker players out there, if the tell in my mind is if an entity is cost plus, they're not generating a profit to fund their own operations, probably not a separate and distinct operation.
All right, that's helpful. Any other examples then?
The third example I give is a treasury center. So parents may establish a legal entity. The sole responsibility is to manage cash or maybe financial risk exposures. Maybe that treasury center is responsible for issuing debt and then is going to fund other parts of the operation. Again, to John's point, these are often funded on a cost-plus basis, and a lot of times in practice we find that these types of legal entities are not considered to be foreign operations themselves.
And then the immediate question that comes to mind before we get into some further examples and discussion, obviously business changes over time. And so I could picture a scenario where you start with you're just the manufacturing facility, and then you start doing procurement, and then you start doing sales, and then you start, and you keep adding on. And so and I'm sorry if I'm jumping too far ahead, but as these changes are happening, then are you each quarter saying, okay, does this meet the definition? And I guess back maybe, John, to your point of the tell, how do you know when you've, quote, crossed the line?
Let's talk about that in a little more detail. I think you're right that this is an ongoing evaluation. You don't set up an entity or an operation and think you're never going to revisit it again.
Right.
That being said, changes in functional currency are expected to be rare. And so it is true that as a business evolves and as you restructure operations or entities, those are good points that you need to revisit the functional currency of it. But it's not necessarily something that you'd expect to see just evolving every quarter and making different decisions. You kind of take a longer term view of what that operation is intended to do over a longer period of time.
All right. This is very helpful.
Yeah, we're going to talk about that longer term view a little bit more later, but that's exactly right. Maybe when you establish the entity, it's an extension of the parent, and then it becomes more autonomous as time goes on. And it makes sense. Sometimes that happens if there's a change in management. They have a different philosophy as to how to run businesses, those types of things.
So that you could change it, but it's not you're going to change it back and forth, basically, or you wouldn't expect to. So, all right. So then, Brett, let's go back to, I know you were talking about sort of starting from the bottom up in the org chart, but how should we then, so I've gone through, you gave a few examples of things that would not likely have a different functional currency, but then how do I think about my entire org chart in this example?
Yeah. So I think you have to start by accepting that you could have a couple different scenarios. And one is where you've got multiple legal entities, but a single foreign entity for functional currency purposes. I just went through some examples of things of operations that themselves may not be considered to be a foreign entity. But it's possible sometimes that you have a single foreign entity for functional currency purposes that's actually made up of multiple legal entities. There are many cases where a company operates similar types of business through multiple legal entities. Like think of a chain restaurant operation. You may have an entity that has 5 restaurants in a single country. Often we see those structured as having separate legal entities for each restaurant. but the restaurants are managed together from product development, advertising, strategy. They're all managed together. And as a result, your reporting entity may determine that, in my example, those 5 separate legal entities form together a single foreign entity for functional currency purposes. You can have the flip side, too, where you have one single legal entity, but 2 separate foreign entities, because one legal entity could have 2 separate and distinct operations in them. And you'd think this is very unusual in practice, but it's actually talked about in the standard. The standard specifically notes that you can have this situation. And if you have separate operations that are conducted in very different economic environments, they could have different functional currencies. Let me give you an example of something we see that could potentially have 2 separate foreign entities within a single legal structure. And it's something we see in Mexico, where a U.S. reporting entity establishes a manufacturing facility that's located in Mexico. And that facility receives a kit, like I talked about before, of raw materials from the U.S. parent. It's going to assemble that product and then deliver it back to the parent for sale to customers. That entity is often called a maquiladora in the local markets. And sometimes that same legal entity, the maquiladora, has a separate business where it produces and sells products locally in Mexico as well. So it's possible in that case that the single legal entity could have 2 separate foreign entities because they're operating in separate economic environments. That manufacturing operation could be deemed just to be an extension of the parent because it's receiving the kit and sending it back to the U.S. parent. And the operation that's producing and selling in the local market could be considered a separate and distinct entity that's operating in the Mexican economic environment and therefore could have the peso as its functional currency. But the key here is that in order to justify that as having 2 operations as separate foreign entities, each separate foreign entity has to produce its own complete set of standalone financial statements. And although this is possible, in practice, we often see that the operations are somewhat intertwined still. They're not completely separate between this manufacturing operation and the sales operation. And so, although it's possible, it's fairly infrequent in practice. But in that case, you're then stuck with having one foreign entity with split indicators, and you're going to have to use more judgment to identify what the functional currency of that entity is, because it's going to have multiple different operations in it, and you've got to select one functional currency.
Yeah, Barry, in all the years I've been doing this, I've seen it a couple of times, and it's for the reason that you cited. They really don't have the ability to separate all of the assets and liabilities into 2 separate entities, if you will, to consolidate, because they would all have to be consolidated separately if they have different functional currencies.
Right. And I guess maybe to that point, John, before we get into understanding how this fits in with the functional currency determination, especially in that first case when Brett was talking about you could have like multiple legal entities. I think your example, there was like 5 restaurants all in one management, but that could be one single foreign entity. Does it matter if you treat them as one or if you treat them as 5?
You just assign them all the same functional currency. Usually a consolidation is done by legal structure.
Yeah.
But, it's sort of like you draw a box around the legal structure and say, these 5 entities are a single foreign entity. They all have the same functional currency.
Okay, so it can be helpful from that point of view. I can see in the second scenario where obviously it's very important because it's going to impact the determination. But maybe that's a good lead-in then, because obviously the reason you are figuring out these foreign entities is to determine then if there's a different functional currency. So John, can you weigh in on that?
Yeah, absolutely. The standard refers to 2 types of entities. The first are those that are an extension of the parent, and those that are
self-contained.
Self-contained.
Yes.
I'm sorry. Those that are self-contained. In our terminology, those that are separate and distinct. So entities that, what I always say is entities that are separate and distinct have the right to their own functional currency. Those entities that are not separate and distinct are the part of some other foreign entity, and the process is to figure out what foreign entity that is. And that's what Brett was talking about as you kind of go through your legal structure. So right now we're talking about entities that we're saying are separate and distinct. And so the standard points out multiple indicators that we should use in order to figure out what the functional currency of that entity is. Sometimes the entity is fully integrated in a single country or currency, and all of their revenues, all of their expenses, all of their financing is done in that currency. Determination of functional currency is easy in that case. Sometimes, honestly, today, most of the time, that's not the case. And so the indicators that the standard focuses on is it talks about just generally cash flow indicators. And those are cash flows related to their assets and liabilities. But the definition of functional currency basically says the functional currency of an entity is the currency of the primary economic environment that that entity operates being the key word. So when we are looking at functional currency determination, even though the standard says that all of these indicators should be considered in conjunction, there's no one indicator more important than the others, I think when we evaluate it, we focus on the operating indicators. And so primarily that's the sales market, sales price, and expense indicators. So think about an environment, for example, the oil industry, for example. If you're in the exploration and production business in oil, most oil today is bought and sold in U.S. dollars. So typically, even if an exploration and production operation is in a country other than the U.S., often those entities are U.S. dollar functional because all of their revenues, or the primary amount of their revenues, are in U.S. dollars. Contrast that, and I know you know a little bit about this market, Heather, to the natural gas markets tend to be more local. And so those, sales price and sales markets tend to be determined locally. And so therefore the driver in a natural gas market would be a local sales price as opposed to outside of that.
So, John, before you go on, though, so let's go back to your oil entity. So its sales are in U.S. dollars, but if it's located outside of the U.S., then its expenses likely are in the local currency. And so then I guess there could be judgment, but you're saying that in that scenario, likely if its sales are predominantly in U.S. dollars, then you would wind up with that functional currency?
Yeah, the way I always think about it is hopefully the company is thinking that they're going to make money, which
fair enough.
Which means that their revenues are going to exceed their expenses.
So then, that's a good way.
The predominance of their operating cash flows are in U.S. dollars.
Okay.
There's other businesses. I think that chip, like computer chips and things like that, I think that's mostly dollar around the world, at least for now. I know there's, some of that is changing.
Yeah.
But I think there, industries like that, revenues are not determined locally or by sales prices and sales markets locally. It's more of a global market.
All right. But to your point, then you're really looking at the predominant currency, basically, when you're determining this.
Yeah. And that's kind of where I was going to go next is when I think about how to evaluate the functional currency, I think about the income statement. And assuming you have a classified income statement, I think about everything above the operating income line in that income statement. And then think about the currencies of those different line items on an absolute value basis and kind of look at what is the predominant currency that you're considering.
All right. And the fact then that, to your point, it's above the line, we would say, at least in utilities. So then the fact you're paying taxes likely maybe in a local currency, that's kind of left out of this equation.
Well, it's not left out. I just think that we think about the operating indicators first. And, I would say, you're always going to be paying taxes in the local jurisdiction. That's, but you're probably paying payroll in the local jurisdiction as well.
Yes.
Now, raw materials can be coming, from different markets. You could have various currencies in terms of that you're paying for your raw materials in, depending on what it is and, what the primary market is for those materials. I guess the last thing to talk about is the financing indicators. And again, we don't disregard the financing indicators, but again, this comes back to the standard was written in 1981. In 1981, it wasn't as easy to finance in any currency you want and swap it back to any currency you want. And particularly when you're talking about intercompany financing, which sometimes you're talking about, that can be denominated in any currency the company wants to denominate it in. So it's not that we disregard it. Sometimes it's a tiebreaker. But to make a functional currency determination based on a intercompany loan that can be denominated in any currency the company wants to denominate it in, I'm not sure that we would say that's the right way to think about it.
And I guess, you made the point on financing with swaps, but also you could be swapping other currency exposures. But again, that would be outside of this consideration. Generally.
Well, I guess we'd have to look at why they were doing that. But yeah,
that's a good point, though. Yeah. Okay, that's a fair point. And I guess maybe, Brett, that's a great lead into them. What are some of the pitfalls when you're thinking about this? Like, what are some of the things we look for?
Yeah, I'd start with a simple one, which is when you're evaluating the functional currency, you're often doing that when you establish that entity. Don't just assume that how you capitalize that entity is going to be its functional currency. You see people's, I just sent down euro as my initial equity investment, so this thing must be euro functional, right? John talked about a whole host of indicators and put financing at the end of the list. And even in financing, you're generally looking to long-term indicators of financing, not just what currency you decided to capitalize or put your initial investment in that entity. And that leads me to this, we've talked about a little bit, this long-term concept of it. I mentioned before, we expect that changes in functional currency are going to be rare. And we'll cover that more. But all of these indicators should be assessed on a long-term view of the operations and the strategy of a business. We often deal with this in startup companies. You think of this as your expected economic environment over the long term. You may have startup operations with a lot of expenses in the local currency, but you have a longer term view of generating US dollar sales. It could go other ways. So we encourage people to not focus on just the near term, what's happening in the next several months and several years, but the long term and what are their business plans, what's their core strategy, and take that long term view when you're establishing the functional currency of that. And keep in mind that there's going to be a lot of judgment here. We have a lot of legal entities that are going to have different indicators, and the indicators, like John mentioned, aren't going to go all in one direction. You're going to have transactions in multiple currencies, but at the end of the day, each distinct and separable operation can have only one functional currency that you've got to identify, using all of these factors.
Yeah, and it's interesting. I was just thinking when you said thinking over the long term. So now I have high hopes for this business, and I'm expecting something to happen in 5 years. I get 5 years out. It didn't pan out the way I wanted it to. I could see if I was the entity making that assessment on day one, it's a little uncomfortable, right? To be determining the functional currency based on predictions. So I'm guessing that does come into the conversation that people sometimes prefer to focus on what's right in front of them. But you're saying, no, you really need to make your best assessment.
Yeah. and obviously when you do that, you have to differentiate between hopes and dreams and reasonable expectations and plans. You don't want to establish this functional currency on kind of the wildest expectations that could happen. But at the end of the day, it's going to require some judgment if you are in that kind of startup operation where you think that your operations are going to evolve significantly over time.
Okay. So, John, how about from your point of view, what are some of the areas of judgment that you think about?
Heather, one of the areas we have lots of conversations about is when you're dealing with entities that are not separate and distinct. And remember we talked about if an entity is not separate and distinct, you have to figure out which separate and distinct operation it's a part of. So this happens all the time. We have these conversations all the time with respect to holding companies. Holding company is a legal entity established. Primarily, it just holds investments in other operating entities. It may have financing, intercompany financing going through that entity as well. Sometimes you see that. Or they could have separate shell companies that they have their intercompany financing run through. The standard basically says that For an entity that's just a shell corporation, they are just to hold investments or particular assets. For example, you see a lot of time intellectual property being held in companies that don't do anything except for hold the intellectual property. That the functional currency generally, is the word used in the standard, should take the functional currency of its immediate parent, right? And so I kind of think of it like, yeah, the default is the immediate parent. Maybe that's too strong a word, but sometimes it's not always the case that you would just default to the immediate parent. I'm not sure you get in trouble for doing that, given the words in the standard. But think about a holding company that's just holding investments in other operations. And let's say that holding company gets most of its financing through the parent, but it also goes out and borrows from a third-party bank portion of its proceeds to fund the operations. Let's just say it's European operations. We may, you have to kind of go through all the facts and circumstances, but you may say in a situation like that, well, maybe that's really integrated with the European operations and not really with the parent. There's a lot of judgment involved in those decisions. Another example would be that certain assets are dropped down into a legal entity. So think about a UK operation, for example, that is purchasing raw materials in Euroland, from Euroland. And so they're purchasing those raw materials in euro. When they do that, they create certain currency exposures. If their functional currency is the sterling, they're purchasing in euro. They have payables in euro. That can create some foreign currency volatility. So somebody at the organization gets a brilliant idea to say, here's what we're going to do. We're going to establish a separate legal entity that's just going to hold the procurement operations for the materials that we're purchasing in Europe. And that way, we'll establish it. Its business will be that of purchasing raw materials in Europe, and we'll establish it as a euro functional entity, and voila, the foreign currency exposure goes away. Well, you can't just wish away foreign currency exposure. So we would probably look at that entity and say, is it separate and distinct? Well, no, because all it's doing is procuring raw materials for the sterling parent. So therefore, it's part of that UK foreign entity, and it should assume the functional currency of that parent. So those are some of the things that we run into with holding companies and shell companies. It requires some judgment and a little bit of logic.
I give listeners two rules of thumb when they're dealing with this. One is when you have a holding and shell company, don't just think you're going to stop at these traditional cash flow indicators, because you're really going to have to dig into what the business purpose of that entity is and figure out its alignment between, like John said, the parent and the subsidiary. And the second rule of thumb, I'd say, is anytime that you think you have a situation where you've created a legal entity that has a different functional currency that's going to change the currency exposure, think twice and think very hard about it, because generally I can't think of many situations where you can just create an entity and eliminate currency exposure. If it's just done for that purpose, it's probably aligned somewhere and needs to have a different functional currency.
Brett, I just want to reiterate your point on, and this is something that comes up all the time on consultations. The first thing that clients' engagement teams, in my experience, want to talk about is the indicators. The first question, and this is why Brett started with foreign entities, the first question is this a separate and distinct operation? And so then, after you make that decision, yes, it is, or no, it's not, then you go to the indicators. Remember, I always use the term, in order to earn the right to have your own functional currency, that entity has to be separate and distinct.
All right, that's helpful. And I guess one point of clarification, because we're talking here about foreign currency exposure. And if you think holistically about foreign currency exposure, the parent company still has that exposure. We're really talking here about accounting, right? Because if you're a US dollar parent, ultimately you are exposed to euro or sterling or whatever else. It's just the accounting for the exposure. Is that right?
I think that's right, but the accounting is obviously going to matter whether
right,
that
very much
through earnings or through CTA, as we're going to talk about.
It's the type of exposure, though.
Yes, so maybe
I think you and I did a risk management thing at one point, but I think about economic exposure and translation exposure.
Yes, yes.
So if I've got an operation in Euroland and they're procuring goods in US dollars, that entity is exposed to change in the US dollar. Their cash flows, their actual cash in their bank account could change based on the exchange rate difference between the time they ordered the product and the time they took delivery of the product and paid the bill, right? Whereas once you've measured all of your monetary assets and liabilities, we're going to speak about this in a little bit, into your functional currency, then you're talking about translation exposure, and that's really just an accounting exposure. Now, presumably, the parent will ultimately distribute some of those earnings to the parent, so they'll recognize some there, but the accounting exposure is, it shows up in our financial statements, but it doesn't show up in our bank account.
Right. Okay. That's an important distinction. Yeah. All right. And then, John, any other areas that you'd want to highlight in terms of where there could be issues?
Yeah. I think one of the things we deal with quite often is when a company goes out and buys another foreign operation, acquisitions of companies. And, I guess the mantra there is don't just assume the functional currency that the seller had established for those operations that you've just purchased. Usually when you buy a business, you're thinking about synergies. How are we going to create synergies and merge this with our operations? You need to think about all those things because the prior owner may have treated the business like an extension of the parent. You may have a different view that you want to operate that business autonomously, or you're going to combine it with your operations locally, and then, it'll be an autonomous operation. And so, it's very possible that the way that the acquirer plans to manage the business could be very different from what the prior owner was doing, and that could have an impact on the functional currency determination. Maybe you're going to merge it with other products that are complementary, and you're going to manage it as the same business, but that's going to change the cash flows that business has. And so you need to think about all of those things when you acquire a business. And, that's something we see quite often is, clients and engagement teams, speaking to us about, hey, we're planning to buy these operations. This is how we're planning to change it. How do we think about functional currency determination for those businesses?
Well, and I think the best part of that question was that they're planning to buy. They didn't say we've bought this operation.
Well, that happens too.
Yes. But always better to think about it when you're still before you've consummated the transaction. So, all right. And then I already asked about changing functional currency. I jumped straight to that. But I do want to make sure we cover that specifically. And again, John, maybe going to you, I know we said it should be rare, but are there circumstances that we see that it is appropriate or that it's more common to make a change?
We do. They are supposed to be rare. The standard uses the term rare. Generally in GAAP, rare means never. I wouldn't say it's never. It's infrequent.
Okay.
It's probably very infrequent. But there's really two types of changes in functional currency when we think about it. The first is we're changing from the reporting currency to the local currency. And the second is we're changing from the functional currency being the local currency to being the reporting currency. Now, interestingly enough, the easier change I'm just talking about man hours, how hard it is to make the change. The easier change is when you're going from the functional currency was the local currency to the parent's currency, the reporting currency. And the reason is because presumably all along we've been translating that local currency to the reporting currency. So my new accounting basis when I make that functional currency change is just my last as translated balances that I had. So I have that information readily available, hopefully. And it's easier to make that change in functional currency. The harder change to make is when you're going from reporting currency to the local currency. Now, this would be a situation that we talked about where, hey, this operation, we used to think about it as an extension of the parent, but we've changed the business for whatever reason. It's going to operate more autonomously. It's going to assume the local currency as the functional currency. That change is harder. And the reason it's harder is because you have to go back to, and look at really the dates all of your non-monetary assets and liabilities were purchased, and assume that the local currency was the functional currency all along, which means you're going to be creating CTA as of the date of the change, as if you had always translated it to US dollars, as opposed to accounting for everything as if it was, again, we're assuming US dollars,
Which is fine. We gave that caveat up front.
But so that's the harder change in functional currency to do. It requires, more work in my experience.
All right. And then I know also one of the things that's popped up a few times over the past couple of years is dealing with highly inflationary economies. So what is the rule there?
Yeah. The account, U.S. GAAP assumes that the unit of measure that you're using for your financial statements is stable. And so the idea behind changing your functional currency when an economy becomes highly inflationary is because the view is that currency is no longer stable, and therefore the financial statements that you're generating are less meaningful because that currency is not stable. So under U.S. GAAP, what they say is if the 3-year cumulative inflation rate exceeds 100%, then that currency is no longer stable, and you need to change the functional currency of that entity, assuming it was the local currency before, to the reporting currency of the immediate parent of that entity. Is the way that I think all most folks interpret the guidance. And that change needs to be made the first day of the reporting period after the reporting period that the determination was made that the economy was highly inflationary. So we've seen that a few times. We've had high interest rate environment, high inflation environment in all countries, including the United States. And so we have seen some pretty large economies go highly inflationary. Venezuela and Argentina being two of the biggest. Turkey, I think, also went highly inflationary a year or two ago. So some pretty decent-sized economies that we're now accounting for as highly inflationary economies.
And then, John, 2 questions on that. So I think, first of all, you made the point that it's the first reporting period after you make the determination. But from a practical point of view, for an individual company, they're likely not making this determination, right? Or is it... Yeah.
Well, I mean, every company should have controls in place to evaluate, the inflationary status of their significant operations. There is a group called the International Practices Task Force, and they meet twice a year in May and November, and they evaluate, virtually all the economies in the world based on data from the International Monetary Fund, and put out a report. For the November meeting, it's usually out in January at some point. In the May meeting, July-ish. But that may not be frequent enough.
Yes, I just realized that when you said that.
To help. But there is a little bit of, nobody wants to be the first one, to say that this is a highly inflationary economy. So there's kind of a little bit of looking around to see what the next person is doing as well. And typically, you see most companies at
the same time.
Yeah.
And then the related question would be that hopefully you would see with these economies that they are highly inflationary and then they move back and they are no longer highly inflationary. So in that circumstance, then, do you reassess the functional currency?
Yeah, I mean, that's the harder decision. Like, I think of the countries I've just mentioned, they're all still highly inflationary. It's a little bit stickier on the way out. Like, U.S. GAAP, basically says if you hit that 3-year 100% cumulative inflation number, you're highly inflationary. There's no judgment there. It does provide that, let's say you're at 90% over 3 years, maybe you want to say that it's highly inflationary based on trends.
Stability or whatever.
The standard does seems to provide some judgment, that situation. But if you're 100, you're highly inflationary. On the way out, it's a little stickier. Right. So I don't know if you go down to 99% 3-year cumulative inflation, you're going to race to go out of highly inflationary status. And again, I think there's a little bit of
wait, look.
Yeah.
All All right. Well, definitely an area of judgment, hopefully one that we won't see more countries entering. So not something, too many companies will have to deal with. So maybe last question. And I think, John, you and I have talked about this on a prior podcast, but you made a point at the beginning. The standard was issued in the early 80s. It's kind of built on that. And we've even talked about some scenarios that are in the standard that we don't think maybe are as common. Obviously, we saw with segments that the FASB said, hey, we had an old standard, maybe wasn't sort of fit for purpose in current times. They have a new standard. Is foreign currency similar to that, or if the model works well enough, the factors haven't changed that much, so we wouldn't think that there would be a change? And again, I know you're speculating.
Well, there's been very few over the last 15 or 20 years, times when the FASB was introducing a new standard where maybe it created a little bit of, hey, the standard doesn't work and play that well with ASC 830 anymore. And so they've had to change some subtle things. We're going to do a podcast on CTA, including CTA release. That was one of the areas. There was a BizCom standard that came out, and there was a little bit of interplay there. So they had to step in and modify 830 a little bit there. There was something in the foreign, if you have investments in debt securities that are in foreign currency, there was some changes there. So
they're kind of keeping it fresh around
patches,
the edges. Then
I would call them like patches.
Yeah, which is good though, right? Because then it continues to work. And I mean, again, you guys described a model that seems very functional. So with that said, I know I'm sorry.
Are we going to let you get away with that? Really?
Wow.
I'm sorry.
And they call these dad jokes? Why?
I'm sorry, listeners benefits the looks on their faces. But honestly, it was the perfect word. So anyway, on that note, thank you. It's always such a pleasure to talk to you. Thanks so much for joining me today.
Thanks.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.